Still long, still optimistic. What underpins that view for you?
So in the very near term, it's earnings. And I think, the things to keep in mind are, number one, the equity market almost always rallies during earnings season. It's not a huge rally. It's about 2.5%. But, that would put us, it would change the handle on the S&P to the mid 4,200s, closer to 4,300. I think on earnings, the big picture issue is very simple, which is that if you look at the top-down macro drivers, what we had is upgrades to growth in the US, in Europe, in China, in Japan. We had the dollar come down. All of that argues basically for, upside in or a rebound or a turn basically in earnings up. And if you look at the same time as what we are measuring earnings against, which is the bottom-up consensus, it's been falling since June of last year. It's down about 16, 17% now. And so when you take the top-down drivers and you plug them into our earnings models or frameworks, it's telling you we should get a pretty significant rebound in earnings. We should get a pretty average beat of about 5%. So there's this narrative out there that the bottom-up consensus is forecasting, the worst earnings season ever and down 7%. I mean, I think they should be a little bit careful with that hypothetical because the earnings beat almost always by 5%. So you're already down to sort of about 1.5%. And so if you get a little bit bigger beat, you saw the results on Friday, you're back at zero.
Okay, well, you get 20 stocks doing well, and the S&P has basically made it halfway back out of a grim bear market. Institutional portfolios maybe have made halfway back is a basic statement. And this is great, Binky, Chadha, in that you take a longer timeline, a more relaxed view, and within that you talk about a passing of the baton from earnings to the next thing to keep your optimism going. What's after our earnings analysis?
Well, it will then depend basically on, the big cloud and whether it's going to erupt into a severe rainfall of the U.S. recession. And there, what I would say is that basically, instead of just looking at the aggregate all the time, we should do what we used to do when the pandemic began, which is differentiate goods and services. And what you will see here is a very, very clear picture. And what I would argue is that, now really comes the test. If you think about a trend line, we've got services that fell far below and have been rebounding and sort of, asymptoting, or the growth rate is slowing basically towards trend. And the important thing to keep in mind about services is they don't generally slow very much. You don't get really recessions in services. And all of the action has really been for the last 2 or 3 years on the good side, where we got massively elevated relative to trend, depending on what metric we were talking about, anywhere between 15 and 25% above trend levels. And it is something that we wrote about in the summer of 2021 called the COVID speed cycle. And since then, what has happened, I would argue, is an incredibly resilient outcome, which is we've been going sideways in real terms for 2 years. And the key question is, as we come back down to trend levels, which we are very near now, are we going to start growing or are we going to suddenly crash?